Have you ever wondered how to fund a business? It's a question that stumps many budding entrepreneurs. Indeed, the quest for capital can often feel like a journey into the unknown, fraught with challenges and uncertainties. Yet it's a vital aspect of starting a business, as essential as having a great idea or a comprehensive business plan. Business funding is the lifeblood that pumps vitality into the heart of a new venture. It's the fuel that propels a business from the realm of ideas into the world of action, from concept to reality. And that's what we're here to talk about today. This video will provide a step-by-step guide on how to fund a business, exploring various strategies and avenues you can tap into. From self-funding to crowdfunding, venture capital to angel investors, loans to grants, we've got it all covered. So, without further ado, let's dive into the world of business funding. Starting off, the most straightforward way to fund a business is through self-funding. But what does that mean exactly? It's quite simple, really. Self-funding, also known as bootstrapping, is where you use your own personal finances or assets to start and operate your business. This could be from your savings account, retirement funds, or even selling off assets like your car or property. Now, let's dive into the advantages of self-funding. The most apparent benefit is the fact you retain complete control over your business. You don't have to answer to investors or lenders, and you can run your business exactly how you see fit. Moreover, there's no interest to pay or equity to give away, so all the profits belong to you. However, like all things in life, self-funding has its disadvantages. The most glaring one is the risk involved. You're putting your own money on the line, and if the business fails, you could lose it all. It's a high-stakes game, and not everyone is comfortable with that level of risk. Additionally, self-funding can limit the growth of your business, as you only have access to a finite amount of capital. So, when is it a good idea to consider self-funding? Well, it's an excellent option if you're starting a low-cost business, like an online store or a consulting service. It's also a good fit for those who have significant personal savings and are comfortable with the risk. Furthermore, if you're passionate about maintaining full control over your business and its direction, then self-funding could be the right choice for you. Remember, self-funding is not a one-size-fits-all solution. It's important to consider your personal circumstances, your risk tolerance, and the nature of your business before making a decision. In the end, self-funding can be a viable option, especially for those who have significant personal savings. But it's not the only way to fund a business. Another popular method of funding a business is through crowdfunding. Crowdfunding is essentially a way of raising finance by asking a large number of people each for a small amount of money. Traditionally, financing a business project or venture involved asking a few people for large sums of money. Crowdfunding switches this idea around, using the internet to talk to thousands, if not millions, of potential funders. Now, let's delve into the different types of crowdfunding. There's reward-based crowdfunding, where people give money in exchange for a reward, which is often a product or service that your business offers. Then there's donation-based crowdfunding, where people donate to a cause or project without expecting anything in return. Equity crowdfunding is another type, where people invest in an opportunity in exchange for equity. Money is exchanged for a share in the business, project, or venture. And lastly, there's debt crowdfunding, also known as peer-to-peer lending, where people lend money in return for interest payments and a repayment of capital over time. Each type of crowdfunding has its own set of advantages and disadvantages. The pros include a potentially quick way to raise finance, with some platforms offering a network of millions of potential investors. It can also be a valuable form of marketing and customer engagement, as well as a useful way to test the public's reaction to your product or service. However, the cons should not be overlooked. If you fail to meet your target, any finance that has been pledged will usually be returned to your investors, and you will receive nothing. Furthermore, not all projects are right for crowdfunding. Some projects are too personal or not interesting enough to gain the attention and interest of the crowd. While crowdfunding can be an excellent way to raise funds, it's not suitable for every business. So, it's crucial to consider your business type, your market, and your capacity to deliver on promises before jumping into the world of crowdfunding. For larger amounts, entrepreneurs often turn to venture capital or angel investors. You see, both venture capital and angel investors represent substantial sources of funding for businesses. But what exactly are they? Venture capital is a subset of private equity where investors provide funding to startups and small businesses that they believe have long-term growth potential. These venture capitalists often come as firms, pooling funds from various sources. On the other hand, angel investors are typically high net worth individuals who provide financial backing for small startups or entrepreneurs, often in exchange for ownership equity. They might be a successful business person, a retired executive, or even someone from your personal network who sees potential in your idea. So, how does one go about securing funding from these sources? Well, it's not a walk in the park. It requires preparation and perseverance. You need a solid business plan, a compelling pitch, and often a proven track record. Once you've caught their interest, there will be negotiations, due diligence checks, and legal processes to navigate. Now let's talk about the perks. The most obvious benefit is the large sum of money that can be injected into your business. This funding can help accelerate growth, fund research and development, or even help your business weather tough times. Additionally, these investors often bring more than just their checkbooks. They provide valuable advice, industry connections, and lend credibility to your business. However, there's no such thing as a free lunch. In exchange for their investment, both venture capitalists and angel investors will typically want a piece of the pie. That means a portion of your company's equity. This could translate into a loss of control over certain business decisions. They will also expect a return on their investment, which could put pressure on your business to perform and grow rapidly. Venture capital and angel investors can provide significant funding, but they often demand a stake in your business. So it's crucial to weigh the benefits against the potential drawbacks before diving in. After all, the right funding choice can make or break your business. Loans and grants can also be a reliable source of funding. When it comes to building your business, acquiring the necessary capital can often be the most challenging part. However, there's a broad spectrum of loans and grants available to help entrepreneurs kickstart their dreams. Let's delve into loans first. Essentially, a loan is a sum of money that's borrowed and expected to be paid back with interest. There are various types of loans tailored for businesses. For instance, there are traditional bank loans, microloans for small-scale businesses, and even online loans for quick and easy access to funds. To secure a loan, you'll typically need a solid business plan, a good credit score, and sometimes collateral. The upside of loans is the substantial amount of capital they can provide. However, the downside is the obligation to repay the loan with interest, which can be a financial burden. On the other side of the coin, we have grants. Unlike loans, grants are essentially free money. They're funds given by an organization, usually a government entity or a foundation, that you don't have to repay. There's a myriad of grants available for businesses, especially for those in specific industries, minority-owned businesses, or startups that are innovating in certain fields. The application process for grants can be quite rigorous, requiring in-depth business plans and proposals. The advantage of grants is, of course, the fact that they don't need to be repaid. But the competition for these funds can be fierce, and there's no guarantee of success. In conclusion, both loans and grants can serve as viable options for funding your business. They each come with their own set of pros and cons, and it's crucial to weigh these factors before deciding which path to take. Remember, what works for one business might not work for another, so it's important to consider your unique circumstances and needs. Loans and grants can offer a lifeline to businesses in need of funding, but they also come with their own set of challenges. So, we've explored several ways to fund a business, each with its own advantages and disadvantages. Self-funding allows you to maintain full control of your venture, but it also requires a significant personal financial commitment. Crowdfunding, on the other hand, harnesses the power of the crowd, giving everyone a chance to contribute to your venture's success. Yet it requires a compelling story and a wide reach. Venture capital and angel investments can provide substantial funding, but they typically demand a share of your company and a say in its direction. Loans and grants are traditional methods of funding, with loans needing to be paid back with interest, while grants, being free money, often come with strings attached and a competitive application process. Remember, the right funding method for your business depends on many factors, so take your time, do your research, and choose the one that best suits your needs.